All right, learners, welcome to another deep dive. Today, we're going to be looking at how to think about business strategy a little bit differently.
Yeah, we're going to be drawing on a lot of the wisdom of the legendary investor Peter Lynch.
Exactly. And I think what makes Lynch so interesting is even though he's known as this master stock picker, his ideas about business, they go way beyond just picking stocks, you know?
Absolutely. Like the core principles that made him so successful on Wall Street, they're actually applicable to anyone building or running a business. And that's what we're going to dig into today.
Yeah, we're going to be focusing on those core strategies, avoiding common mistakes, and learning to really spot those winning opportunities.
And for this deep dive, we're going to be drawing from two main sources. First, we've got excerpts from a text called The Peter Lynch Playbook, Your Guide to Strategic Business Thinking.
Okay, so that sounds like it takes some of Lynch's core ideas and makes them really accessible for a business audience.
Right, it's like a distilled version. And then we're also going to go straight to the source with excerpts from Lynch's book, One Up on Wall Street, which is like a classic for a reason.
Yeah, so we'll get the playbook's concise insights, but then we can also see how Lynch himself explained and illustrated those ideas with real-world examples.
Exactly. We'll get the big picture and the nitty-gritty details.
All right, so let's jump right into it. And the playbook starts off by hitting on something so fundamental, strategic business thinking, and it all comes back to profitability.
Right from the very beginning, it emphasizes this question: how will this decision impact our profitability and our ability to generate earnings over the long term?
Okay, so it's not about chasing fads or vanity metrics. It's about building a sustainable business that actually makes money.
Yeah, and the playbook really stresses this idea of building a robust business model, one that can weather storms and keep generating profits.
Okay, and that leads right into their next point. The common pitfalls businesses make when they lose sight of that core principle of profitability. Like the playbook talks about how mature companies sometimes fall into this trap of trying to force really rapid growth.
Right, they try to recapture that early stage hypergrowth. But for a mature company, that's often just not realistic.
Yeah, they end up overextending themselves, spreading their resources too thin, and it backfires.
And Lynch himself, in One Up on Wall Street, he has a lot to say about this kind of phenomenon. Like he often pointed to periods like the dot-com boom, where stock prices got way ahead of reality.
Oh, yeah, everyone was so caught up in the hype of the internet, but a lot of those companies, their valuations were based on these huge expectations of future growth that just never materialized.
Yeah, exactly. People were basically paying a huge premium for potential, not actual performance.
So it was kind of like a gamble on what might happen way down the line, not what was actually happening in the present.
Right. And then on the flip side, you have those fast-growing companies that do have a kind of momentum, but they run into problems because they don't build the necessary infrastructure to support all that growth.
Oh, yeah, like they don't put the systems and processes in place they need, and then when they try to scale up, everything starts to fall apart.
Right. The playbook highlights how this lack of a solid foundation can really trip up companies as they try to expand.
Okay, so it's like you need that strong base to build on, otherwise the whole thing becomes unstable.
Exactly. And another really relevant point the playbook makes is about cyclical businesses.
Oh, right. Those industries like airlines or auto manufacturers that go through these predictable upswings and downturns.
Yeah, exactly. And the playbook stresses that if those companies don't adequately prepare for those inevitable downturns, they can find themselves in big trouble.
Yeah, it's like they get caught out by the changing tides and One Up on Wall Street. Lynch actually talks about this too, doesn't he?
He does. He mentions companies like Chrysler and LTV as examples of businesses that operate in these cyclical industries.
So it's a reminder that those ups and downs are just part of the game in certain sectors and you have to be ready for them.
And I think if we zoom out a little bit, the recurring theme here is this temptation to overvalue companies based on future projections rather than on their current actual performance.
Oh, yeah, like getting caught up in the potential instead of looking at the hard number.
Exactly. And Lynch talks about how there are these periods where just having .com in your company name or being associated with a hot new trend was enough to get investors really excited.
Right. It's like the hype overshadows the reality of the business itself.
And the playbook also points out how this lack of focus on actual profitability can lead to unsustainable business models.
Like you can have all the buzz in the world, but if you're not actually making money, it's not going to last.
Right. And Lynch, in One Up on Wall Street, he gives some really interesting examples of this. He talks about industries like mobile homes or digital watches that were super high for a while. But ultimately, a lot of those companies struggled to turn that initial excitement into consistent profits.
Yeah, it's like sometimes the excitement about a new technology or a new trend it can distract from the basic fact that you need to make more money than you spend.
Exactly. Strong sales are great, but if you're not managing your costs effectively, those earnings are going to suffer.
Okay, so it's not just about generating revenue, it's about controlling costs and focusing on that bottom line.
And Lynch's principles really force us to think about the net result, the actual profit, not just the top-line revenue.
Okay, so who are some companies that are actually getting this right according to the playbook?
The playbook points to some big tech companies like Microsoft and Intel as examples of companies that are really focused on generating strong earnings.
Yeah, they've obviously had these periods of massive growth, but now they're really focused on maintaining their market dominance and driving profits through continuous innovation.
Right. And one up on Wall Street, Lynch even mentions how the potential of Intel was something that even an average person could see.
So it wasn't just this complicated Wall Street thing. Their success was based on something fundamental and understandable.
Exactly. And the playbook also highlights consumer goods companies like Procter & Gamble as examples of businesses that are really good at maintaining healthy profit margins across their product lines.
Right. Procter & Gamble, they've been around forever, and they're known for their focus on efficiency and consistent profitability.
Yeah, one up on Wall Street even lists them as a stalwart, a company that's just built to last.
Okay, so I think a key takeaway here is that sometimes focusing on the fundamentals can be more powerful than chasing the next big thing.
Absolutely. It's about building a solid foundation for long-term success.
Okay, so let's shift gears a little bit and talk about research, because this is something that Peter Lynch was hugely passionate about.
Yeah, he really emphasized doing your homework, what he called doing your detective work.
Right, and the Peter Lynch playbook is very clear on this point. It says you can't just rely on gut feelings or rumors.
You've got to do that thorough research into your industry, your competitors, and the potential impact of your strategic decisions.
Okay, so it's about looking at data, but it's also about talking to people, right?
Absolutely, like talking to your customers and experts in the field, that's how you get those real-world insights.
And the playbook then goes on to highlight some of the costly mistakes that businesses make when they don't do that research. Like a classic example is expanding into new markets without really understanding the local dynamics.
Yeah, that can lead to some really expensive failures. But one up on Wall Street, it actually provides a great counterexample. It talks about La Quinta's very successful expansion.
Yeah, La Quinta, they really focused on understanding the specific needs of small business travelers, and that's what drove their growth.
Exactly. And it's a perfect example of how targeted research can give you a competitive advantage.
The playbook also warns against making acquisitions based solely on hype or excitement without really understanding the fundamental value of the business you're buying.
Right. And Lynch uses a really memorable term for this. He calls it diversification.
Diversification. I love that. So it's like the opposite of creating synergy. It's when those acquisitions actually harm the business.
Exactly. And One Up on Wall Street goes into detail about how diversification often happens when companies overpay for businesses that don't align with their core operations.
Right. It's like they get distracted by the shiny new thing and lose sight of their strengths.
Exactly. And then often those acquisitions end up being sold off at a loss later on.
Okay, so the big lesson here is that well-informed decisions grounded in research and real insights are so much more likely to lead to success than just following your gut or chasing trends.
Absolutely. It's about being strategic and intentional with your business decisions.
All right, so now let's move on to another really interesting aspect of Lynch's approach, this idea of how to spot the winners.
And this is where things get a little bit counterintuitive, because the Peter Lynch playbook explains that Lynch often looked for companies that were a little bit dull or simple or even misunderstood by the wider investment community.
Okay, so not necessarily the flashy high-growth companies that everyone's talking about.
Right. He actually saw a lot of potential in those less obvious places.
And the playbook explains that these kinds of companies, those Lynch-style winners, they often have some key advantages, like less competition and simpler business models.
Exactly, because they're not as glamorous, they don't attract as much attention, so you have more room to maneuver.
And One Up on Wall Street, Lynch really champions this approach. He talks about companies with boring names doing boring but essential things.
Like Crown Cork and Seal. They make cans and bottle caps. Not very exciting, but hugely profitable.
Right. And then there's Seven Oaks International. They processed grocery coupons. Definitely not a sexy business, but they did incredibly well.
And what's interesting is these types of businesses often fly under the radar until their consistent performance becomes impossible to ignore.
Yeah, it's like they're quietly building this solid foundation while everyone else is chasing the latest fads.
Exactly. And the Peter Lynch playbook then goes on to outline some of the common mistakes that competitors make when they overlook these kinds of opportunities.
Okay, like what are they missing out on by not paying attention to the dull and the simple?
Well, one mistake is chasing after the hottest technologies without having a real sustainable advantage.
Right. It's like jumping on the bandwagon without really thinking about how you're going to stand out in the long run.
And that can be really dangerous, especially in markets that are easy for new players to enter.
Yeah, today's groundbreaking innovation can quickly become tomorrow's commodity.
And Lynch, in One Up on Wall Street, he specifically warns against just blindly investing in the hottest stocks in each successive hot industry.
Okay, so don't get caught up in the hype cycle. Think about the long-term viability of the business.
Exactly. And the playbook also points out how sometimes businesses can become so focused on developing complex innovations that they miss out on addressing some really fundamental needs.
Right, it's like they're so busy looking for the next big thing that they overlook the simple but important problems that people are still facing.
And One Up on Wall Street actually has a great example of this. It talks about Cajun mildew remover for leather jackets.
Okay, so a very specific solution to a very specific problem.
Yeah, and it highlights this idea that sometimes the biggest opportunities lie in addressing those everyday needs that everyone else is overlooking.
So it's not always about being revolutionary. It's about solving real problems, even if they seem mundane.
And the playbook also touches on this idea of not overlooking spin-offs.
Oh, right, when a company basically splits off part of its business into a separate, independent entity.
Exactly, and One Up on Wall Street, Lynch uses the example of the Baby Bell companies that were spun off from AT&T.
Yeah, those Baby Bells, they actually ended up outperforming both the parent company and the broader market.
Right, so it's a reminder that sometimes these spin-offs can create really valuable opportunities.
Okay, so if we take all of this and try to apply it to finding business success, it seems like a lot of it comes down to looking beyond the hype and the trends.
Yeah, it's about identifying those unexciting but necessary needs, those niche markets where competition isn't as fierce, and even those undervalued parts of bigger organizations that might thrive if they were on their own.
Right, and One Up on Wall Street does a great job of illustrating this contrast. It talks about Pep Boys, a company with a pretty ordinary name that just kept delivering solid results.
Yeah, versus something like Gino's Place International, which sounds super cutting edge, but ultimately didn't go anywhere.
So sometimes the most promising ventures are hiding in plain sight precisely because they don't generate that same level of excitement.
Exactly. They're not flashy, but they're built to last.
All right, so let's wrap up by talking about the flip side of spotting winners, how to steer clear of trouble, how to avoid those really risky ventures.
Right. This is the risk management side of Lynch's philosophy, and the Peter Lynch playbook has some really clear advice here.
Okay, look, what are the red flags we should be looking out for?
Well, first of all, be wary of those hot stocks and hot industries, the ones that everyone's talking about.
Yeah, it's easy to get caught up in the excitement, but often those stocks are already overpriced.
And then there are the whisper stocks, the
Yes.
ones that are based on rumors and unsubstantiated hype.
Yeah, those are really dangerous because there's often no real substance behind them.
And then perhaps most surprisingly, the playbook also advises against excessive diversification, what Lynch famously called diversification.
Okay, so it's not always about spreading your bets. It's about staying focused.
Exactly. And One Up on Wall Street goes into detail about how diversification often happens when profitable companies start making acquisitions outside of their area of expertise.
Right, it's like they have all this cash and they feel like they need to put it to work, but they end up investing in things they don't really understand.
And that often leads to costly mistakes. Those acquisitions end up being restructured or sold off at a loss.
Okay, so the lesson here is to stick to your core competencies and resist the urge to chase every shiny new object.
Precisely focus on what you do well and avoid spreading your resources too thin.
All right, so as we wrap up this deep dive into Peter Lynch's approach to business strategy, I think the key takeaway for you, the learner, is that it all comes down to thinking for yourself, doing your homework, and not being afraid to look in those less obvious places.
It's exactly.
Right.
Prioritize profitability. Do your research, focus on those unexciting but essential needs, and be wary of hype and over-diversification.
Right. It's about being strategic and intentional with your business decisions. And here's a final thought to leave you with going. Lynch often talked about the power of what he called dumb money.
Right, the idea that everyday investors can sometimes spot opportunities before the Wall Street professionals do.
Yeah, because they're not caught up in all the complex financial models. They're just looking at the world around them.
Exactly. So the question for you, the learner, is how can you leverage your own unique perspective and your own experiences to identify those overlooked opportunities?
Right, because those insights, that's a real advantage that you can cultivate.
Absolutely. It's about seeing the world with fresh eyes and being open to those unexpected possibilities.
Well, we hope this deep dive has given you some food for thought and maybe even some actionable strategies to apply in your own world. We encourage you to explore Peter Lynch's work further and see what resonates with you.
And until next time, keep observing, keep learning, and keep building strategically.
We'll see you on the next deep dive. All right, learners, welcome to another deep dive. Today, we're going to be looking at how to think about business strategy a little bit differently.
Yeah, we're going to be drawing on a lot of the wisdom of the legendary investor, Peter Lynch.
Exactly. And I think what makes Lynch so interesting is even though he's known as this master stock picker, his ideas about business, they go way beyond just picking stocks, you know?
Absolutely. Like the core principles that made him so successful on Wall Street, they're actually applicable to anyone building or running a business. And that's what we're going to dig into today.
Yeah, we're going to be focusing on those core strategies, avoiding common mistakes, and learning to really spot those winning opportunities.
And for this deep dive, we're going to be drawing from two main sources. First, we've got excerpts from a text called The Peter Lynch Playbook, Your Guide to Strategic Business Thinking.
Okay, so that sounds like it takes some of Lynch's core ideas and makes them really accessible for a business audience.
Right, it's like a distilled version. And then we're also going to go straight to the source with excerpts from Lynch's book, One Up on Wall Street, which is like a classic for a reason.
Yeah, so we'll get the playbook's concise insights, but then we can also see how Lynch himself explained and illustrated those ideas with real-world examples.
Exactly. We'll get the big picture and the nitty-gritty details.
All right, so let's jump right into it. And the playbook starts off by hitting on something so fundamental, strategic business thinking, and it all comes back to profitability.
Right from the very beginning, it emphasizes this question: how will this decision impact our profitability and our ability to generate earnings over the long term?
Okay, so it's not about chasing fads or vanity metrics. It's about building a sustainable business that actually makes money.
Yeah, and the